Welcome to the Nuanced Executive. Today we're not just looking at a case study, we are effectively stepping into a time machine. We're going back to a moment that I think really defined what modern money looks like in India, even if most people didn't realize it at the time.
It's a moment that sits right on the fault line of history. I mean, on one side, you have centuries of tradition, and on the other, the absolute bleeding edge of the new millennium.
And when those two plates collided,
It created the banking landscape we all walk on today.
we're talking about the year 2000. And before we get into the heavy lifting of balance sheets and, swap ratios, I really want to set the scene. Because 2000 feels like yesterday to some of us and, well, ancient history to others.
It was a very specific vibe.
Hmm.
The Y2K bug scare had just passed without the world ending, which was a relief.
Right, we all survived.
The dot-com bubble was vibrating. Everyone was talking about eyeballs and clicks.
Hmm.
But if you walked into a bank in India in 2000, it did not feel like the future.
Oh, absolutely not. I remember those days. You'd walk in, and it was the sound of dot matrix printers, that screech, zip, screech sound.
Yes.
And the smell of old paper and dust. And you had the token system. You'd get this little brass token and wait for, 45 minutes just to withdraw your own cash?
Exactly. Banking was a physical ordeal. It was high friction. And in this landscape, there were two players who could not have been more different if they tried. They were like two different species of animal trying to inhabit the same ecosystem.
On one side, you had the New World, ICICI.
ICICI, the predator, you could say, the new kid on the block. Now, they had technically been around as a development finance institution, but as a commercial bank, they were toddlers. Founded in 1994, only 6 years old.
But they didn't act like toddlers.
No, they acted like teenagers in a huge hurry. Aggressive, urban, tech-obsessed. Their offices didn't smell like dust. They smelled like, fresh air conditioning and ambition. They were the first to really push ATMs, the first to push internet banking when most people were still using those dial-up modems that screamed at you when you connected.
And then on the complete opposite end of the spectrum, you had the old world, the Bank of Madura, or
Boom, boom.
as we'll probably call it.
BOEM was history incarnate. Established in 1943, so before independence, by Karamothu Thiagarajan Chettiar. We need to pause on that name, Chettiar. It's not just a surname. It represents a banking tradition that goes back centuries.
Right, this wasn't just some random corporate entity. The Chettiars were the original bankers of South India, weren't they? They were doing cross-border finance in Southeast Asia long before SWIFT codes were even a concept.
Precisely. The Chettiar ethos was built on the Hundi system. These bills of exchange based entirely on honor and lineage. A Bank of Madura branch manager in a dusty town in Tamil Nadu didn't look at your CIBIL score, which didn't exist then. He looked at your face. He knew your father.
You knew your grandfather.
He knew if your family kept its word.
That is a beautiful way to do business, high trust, high social capital. But it doesn't exactly scale, does it? You can't put, I knew his grandfather into an Excel spreadsheet.
And that is the crux of the conflict we're unpacking today. Bank of Madura had a massive footprint, 263 branches, mostly in rural Tamil Nadu. They had 2 million loyal customers. But they were operating on that old world social objective model. It was mass banking, not class banking.
And their workforce must have reflected that.
Heavily. They had about 2,500 employees. And these are people who joined the bank expecting a job for life. They were unionized, they were older, and they were used to the slow, steady rhythm of the ledger book.
So you have ICICI, 1,400 employees, young, wearing ties, obsessed with shareholder value. And then BUM, 2,500 employees, older, focused on community service. And yet, in December 2000, ICICI decided to buy them.
And this is where the mystery begins, because on the surface, this looked like a terrible idea. ICICI was sleek and profitable. BUM was, well, let's just say troubled.
Troubled is putting it mildly. We have sources here, specifically a contemporary analysis by an analyst named Ajay Shah, that suggests BOEM was technically bankrupt.
Got a harsh word, bankrupt, but mechanically looking at the numbers, it might have been true.
So why? Why would the smartest guys in the room at ICICI buy a bank that was technically underwater? That's the question. That's our mission for this deep dive. To unpack how this merger became this incredible case study for synergy over pure financials and how a massive culture clash was engineered into a win-win.
To understand that, we have to strip the paint off the walls and look at the financial autopsy. We need to look at what the market was seeing versus what ICICI was seeing.
Let's dig into that, because usually when a company buys another company, they're buying assets, they're buying profit. But here, the deal structure was, it was a stock swap.
Correct. A 2-for-1 swap. If you held one share of Bank of Madura, You received 2 shares of ICICI Bank. No cash, changed hands.
And the market reaction was wild. Bum stock hit the upper circuit. It went up as fast as the exchange would allow it
It
to.
just exploded upwards.
But ICICI stock, it fell. The market was basically screaming, ICICI, what on earth are you doing?
The market was looking at the books. And if you looked at the books using standard accounting, it was scary. But Ajay Shah's analysis used a different lens, something called option pricing theory.
Okay, I have seen this term in the notes, and it sounds incredibly academic. Option pricing theory. Can we unpack this without needing a PhD in math? How does this apply to a rusty old bank in Tamil Nadu?
It's actually a fascinating way to view a company in distress. Think of it this way. The equity of a company, the shares you and I buy, is really a call option on the company's assets.
A call option, right? That gives you the right to buy something at a certain price later. It's a bet that the price will go up.
Exactly. Now, in a company, the shareholders only get paid after the debt holders. In a bank, the depositors are paid. If the assets are worth 100 and the debt is 80, the shareholders own 20. Simple.
Right. Assets minus liabilities equals equity. Basic accounting.
But what if you aren't sure what the assets are worth? What if the loans are bad? What if the assets are actually 70 and the debt is 80?
Then the shareholders own -10. They're underwater. The stock should be worth 0.
In a perfect world, yes. But in the real world, there's volatility. There's uncertainty. Maybe those bad loans will get paid back. Maybe the government will bail them out. So even though the real value is -10, the stock still trades at a positive price. It becomes a lottery ticket.
I see. So the Bumham stock was a lottery ticket. The fundamental math said this is worthless, but the chance of a miracle kept the price above 0.
Exactly. Shah's model estimated that BOM had a hole of about 350 crore rupees. Its assets were less than its liabilities. And worse, it had leverage of 41 times.
41 times leverage. That's terrifying. That means for every rupee of their own money, they had borrowed 41 rupees.
Roughly. It means a tiny, tiny drop in asset value wipes them out completely. To meet the Basel Accord safety standards, the global rules for banking safety BOM needed an immediate infusion of 800 crore rupees.
Oh, yeah. But their total market cap was only 100 crore. You can't ask the market for 800 crore when you're only worth 100. That's impossible.
It was a death spiral. BOM was a zombie walking. It was just waiting to die. The only options were, 1, the regulator shuts them down, which is a disaster. 2, a forced merger with a public sector bank, which is messy.
And then option 3, ICICI swoops in.
The godsend. That is why the BOM stocks skyrocketed. ICICI basically said, we will trade your worthless lottery ticket for 2 shares of a solid high-growth company.
But I have to play devil's advocate here. If I'm an ICICI shareholder, I am furious. Why are we paying a premium for a hole? Why are we taking on a 350 crore loss? Why not just wait for them to die and pick up the branches at a fire sale?
That is the multi-crore question.
Yeah.
And it brings us to the difference between financial valuation and strategic valuation. An accountant looks at the past. A strategist looks at the future.
So what did KV Kamath, the CEO of ICICI, see that the accountants didn't?
Time. He saw time.
Time.
ICICI wanted to be a national player. To do that, you need branches. You need a physical footprint. You need to be where the money is. Building 263 branches from scratch, buying the land, getting the permits, building the walls, hiring the staff, trusting the staff, that takes 5 to 7 years.
Right.
Minimum.
And in the dot-com era, 5 years is an eternity.
Exactly. ICICI calculated that the 350 crore hole was basically the price of speed. They bought a 5-year head start in South India. They bought 2 million customers instantly.
So they didn't buy a bank, they bought a distribution network.
And they bought liquidity. This is the nuance. BOM was inefficient, yes, but it was sitting on mountains of cheap deposits. Rural customers in India, they leave money in savings accounts for years. They're sticky. They don't chase interest rates.
Low-cost funds. The holy grail for any bank.
The holy grail. ICICI was thirsty for cash to lend out to the booming corporate sector in Mumbai and Delhi. They took the cheap rural money from Madurai and lent it to the skyscrapers in Mumbai. That arbitrage is where the profit was.
Okay, so the spreadsheet logic, once you squint at it, actually starts to make sense. You buy the network, you plug the hole, you use the cheap cash, but spreadsheets don't talk back. People do.
And this is where we move from the financial engineering to the social engineering, because you can swap stocks in a day. But merging cultures takes years.
Let's talk about that culture clash, because I can only imagine the terror in the Bank of Madura break room when the news broke.
Oh, the panic was real. You have to understand the psychology of the public sector, or quasi-public sector employee in India at that time. The iron rice bowl, right? The job is safe. You can't be fired unless you, I don't know, steal money, basically.
And suddenly, you're owned by ICICI, the cowboys of capitalism, the perform or perish guys.
The rumors must have been flying. They're going to fire everyone over 50. They're going to close all the rural branches because they only care about cities. They're going to make us speak English all the time.
And honestly, those fears weren't completely unfounded. ICICI was aggressive.
They were, but they were also smart enough to know the law. In India, labor laws are incredibly strict. You cannot just fire 2,000 people. The unions would have shut down the entire banking system.
Right, the unions in the banking sector are incredibly powerful. If the bum unions went on strike, it could have triggered sympathy strikes across the country, a national crisis.
Exactly. So ICICI couldn't use the stick. They had to use the carrot. They had to execute a psychological turnaround.
But how do you do that? How do you turn a 55-year-old ledger keeper who, frankly, hates computers into a high-octane salesman? That sounds like an impossible HR brief.
It does.
Oh.
But KV Kamath and his team had a strategy. And the core mantra was, performers lead the change.
What's that mean in practice?
It means you break the solidarity of the old guard. In the old system at BOEM, promotions were often based on seniority. You just waited your turn and you moved up. This frustrated the ambitious younger people, or even older but more energetic people, at BOEM who felt stuck.
Ah, so there was a dormant layer of talent inside BOM that was being suppressed by the bureaucracy.
Exactly. So ICICI went in and they identified about 800 officers, that's almost a third of the staff, who were eligible for promotion based on merit, not on age, and they promoted them.
That's brilliant. You instantly create 800 loyalists. You create 800 evangelists for the merger inside the enemy camp.
Precisely. Suddenly the narrative isn't ICICI is here to kill us. It's ICICI is here to finally recognize my talent. It completely split the union's power base.
But what about the folks who weren't promoted? The ones who are genuinely struggling with the new tech, the new pace?
Training. Massive industrial scale training. And integration. This is the other key piece. They didn't just let the BOEM branches stay as these isolated islands. They did what we call cross-pollination.
Mixing the ballet.
They took 450 BOEM employees and transferred them to ICICI branches. And they took 300 aggressive young ICICI kids and dropped them into the old BOEM branches.
I would pay good money to see a reality show about an ICICI hotshot from Mumbai trying to run a branch in a village in Tamil Nadu.
It must have been a culture shock for both sides, but it worked. The ICICI staff brought the pace, the technology, the sales focus. Don't just take the deposit, sell them an insurance policy.
Right.
And the BOEM staff taught the ICICI kids about relationship banking. Don't just sell him insurance. Ask about his daughter's wedding first.
It sounds rosy now, but the sources we have, especially some of these IIMB and SCRIB documents on change management, they suggest it wasn't an instant success.
No, not at all. It followed a classic grief curve. Day one was denial and fear. Month one was sadness. People were genuinely mourning the loss of their old identity. I am a Bank of Madura man. Meant something in their community. Now you're just employee number 4502 at ICICI.
That identity loss is huge. It's not something you see on a balance sheet.
It is. But by year one, there was acceptance. And by year two, there was relief, and then even enjoyment. Why? Because the bank grew. Salaries eventually matched ICICI levels, which were much higher. The branches didn't close. They got renovated. They got air conditioning. They got computers that actually worked.
So success wasn't the day the deal was signed. Success was surviving that 2-year valley of tears without a strike or a mass exodus.
That is the real case study. I mean, this merger is cited in management reviews, not for the money, but for successfully blending two diametrically opposed work cultures. Merging the balance sheets took an afternoon. Merging the souls of the companies took 24 months.
So we've covered the strategy, we've covered the culture. Now let's look at the scorecard. Did it actually work? Or did ICICI just swallow a pill that gave them permanent indigestion?
This is where we look at the data, and we have a great source here. The Asian Journal of Empirical Research. They did a study using something called data envelopment analysis.
Okay, another fancy term. Break it down for us.
It's essentially a way to measure efficiency. Think of a factory. If you put in 100 units of fuel and get 50 units of power, you're 50% efficient. Simple as that. For a bank, the inputs are things like employees and capital, and the outputs are loans and deposits.
Right. How much bang are you getting for your buck?
Exactly. The study found that before the merger, Bank of Madura was operating at roughly 53% to 64% pure technical efficiency.
That is painfully low. It's like driving a Ferrari in first gear.
It's worse. It's like driving a Ferrari in first gear with the handbrake on and the trunk full of rocks.
Yeah.
They were bloated, too many staff, too much paper, not enough profit per branch.
And after the merger, what happened to the efficiency of the combined bank?
In the years following the merger, so 2002 to 2004, the combined entity's technical efficiency and pure technical efficiency scores hit 100%.
100%. That sounds too good to be true. Did they cook the books?
Well, 100% in this context means they were on the efficient frontier. It means they were doing as well as the best possible bank could do with those inputs. It means they successfully deployed the scale. They took those cheap deposits from BOEM, the low-cost funds, and lent them out at high margins. The rocks in the trunk turned into gold.
And this brings up an interesting comparison the study makes. Not all mergers in that era worked out so well.
No. And this is vital for anyone listening to understand. There are two types of bank mergers, broadly speaking, market-driven and forced.
Forced, meaning the regulator, the RBI, holds a gun to your head and says you will buy this failing bank.
Effectively, yes. Look at the merger of Global Trust Bank, or GTB, with the Oriental Bank of Commerce, OBC. GTB was an absolute disaster, fraud, bad loans, a total collapse. The RBI forced OBC, a public sector bank, to eat them to save the depositors.
And OBC got sick.
OBC got very sick. Their efficiency plummeted. They spent years cleaning up a mess they never asked for. They didn't choose the target, they were assigned the target.
Whereas ICICI chose BOEM.
Exactly. It was voluntary. It was a market-driven merger. ICICI did the due diligence. They knew about the hole in the balance sheet, but they had a plan to fill it and leverage the assets. The study's key finding is that market-driven mergers generally create efficiency, while forced mergers often destroy it. Agency matters.
It's the difference between adopting a puppy because you want one and having a wolf thrown into your living room because the zoo closed down.
That is a very vivid analogy. Yes, ICICI adopted a puppy that looked like a wolf to the market, but they knew how to train it.
I want to pivot to the regulatory angle for a moment before we wrap up, because banking is weird. You can't just buy a bank like you buy a shoe factory. There are different rules.
The exit route is the key concept here. It comes from Section 44A of the Banking Regulation Act of 1949.
Okay, so what does that entail for a shareholder?
In a normal corporate merger, if 75% of shareholders vote yes, the other 25% have to go along for the ride. They're dragged along.
Tyranny of the majority.
Right. But in banking, because it's such a sensitive sector, the law protects the dissenter. If you're a BOEM shareholder and you vote no, you have the right to demand cash. You can say, I don't want your ICICI shares. Pay me the value of my BOEM shares in cash right now.
And who decides the price? Not the market.
The Reserve Bank of India. The RBI determines the fair value.
That is a huge risk for the acquirer. I mean, if 40% of BOEM shareholders said, give me cash, ICICI would have had to drain its liquidity to pay them all out. It could have killed the bank.
Exactly. And that is why the swap ratio was 2-for-1. It was generous. ICICI had to make the stock deal so good that nobody in their right mind would ask for cash instead.
So the premium wasn't just charity. It was insurance against this exit route. They paid extra to ensure everyone stayed on the bus.
Strategic generosity. It's a recurring theme in this entire deal. They paid a premium on the stock to keep shareholders happy. They gave promotions to keep employees happy. They spent money to save money.
It's so counterintuitive. We usually think of ruthless executives as people who just cut costs, slash, and burn. But here, the nuanced executive is someone who spends strategically to avoid friction.
Because friction is the most expensive thing in business. Strikes are expensive. Lawsuits from shareholders are expensive. Bad PR is expensive. ICICI paid to make the friction disappear.
So as we zoom out and look at this whole affair nearly 25 years later, what's the final verdict? What's the big takeaway?
I think the most powerful lens to view this through is the concept of the privatized bailout.
Unpack that for us. What does that mean?
Usually when a bank has a 350-crore hole in its books and is technically insolvent, who fixes it?
The taxpayer.
Yeah.
The government steps in, recapitalizes it with public money, and we all pay for it.
Exactly. It's a socialized loss. But here, the government didn't pay a single rupee. ICICI used its own private capital, its high stock price, which is a form of currency, to absorb the loss of Bank of Madura.
They privatized the cleanup.
They did. They took a failing asset, fixed it with private sector efficiency, and created immense value. It saved the government a headache, it saved the employees their jobs, and it made ICICI a giant. It's a rare win-win-win scenario.
It really challenges the idea that distressed assets are just garbage to be avoided.
One man's trash is another man's distribution network.
That is the takeaway for our listeners today. If you're sitting in your office looking at a competitor or a potential partner who looks bankrupt on paper, don't just look at the red ink.
Ask yourself, what do they have that I can't build? Do they have trust in a community? Do they have a network? Do they have a license to operate in a region I can't get into? The hole in their balance sheet might just be the entrance fee for an asset you can't get anywhere else.
Sometimes the best deals are the ones that look the ugliest on the surface.
Nuance. It's all about the nuance.
I think that's the perfect place to land. Let's synthesize this. We started with a bank on the brink, bomb, saved by a giant, ICICI, that was looking for a shortcut to growth.
The on-paper financial valuation looked terrible, buying a technically bankrupt entity. But the strategic valuation, buying a network, customers, low-cost funds, was brilliant.
And the real success, as we've discussed, wasn't the deal signing, it was the 24 months of painstaking HR integration that followed.
Absolutely. The social engineering was more important than the financial engineering.
Which leaves us with a final provocative thought for you, the listener. If ICICI hadn't bought BOM, what would have happened? Would BOM have collapsed, creating chaos for its 2 million depositors? Or would the government have forced a public sector bank to swallow it, dragging that bank down too? ICICI essentially privatized a bailout, creating value where there was a hole. So the question for you to reflect on is this. In your own industry, what looks like a bad buy on a spreadsheet that might actually be a godsend for your strategic positioning?
A great question to ponder.
Well, on that note, we're going to wrap up this deep dive into the ICICI and Bank of Madura merger, a true masterclass in strategy, psychology, and the art of the deal.
It was a pleasure to revisit it, an absolute classic.
If you enjoyed this journey, if you like taking these specific moments in business history and cracking them open to see how the watch works, please do us a favor, share this with a friend who loves strategy, and please like and subscribe to the channel for more such content. It really helps us grow the nuanced executive.
We have some great deep dives coming up that you won't want to miss.
Until next time, keep looking for the nuance. Goodbye.